What's up, you guys? My name's Henry. If you're new, this is another video in the series of making consistent income trading options, because that's my area of expertise when I was working at Goldman Sachs. And in this video, I'm going to explain to you covered call options, how to make $7,500 per month. I'll be showing you live trades. I'm going to be showing you some examples on the whiteboard. I'm going to be showing you how to make consistent weekly and monthly income selling covered calls and the mechanics on how to make it happen properly. I'm going to also cover the benefits of selling call options and why this little known strategy can make you tons of money if, again, you do it properly. Now, number one, selling call options can generate income in which you get paid the option premium up front. Yes, up front when you sell a covered call option. Number two, call option sellers benefit as the time passes and the option decays in value. And this way, the seller basically makes money every single day as the option is open. That's why selling options makes money. Every single day that it decays, you're basically earning more money, because if you were to buy it back, you would have a gain on your hands. Number three is selling call options is a fantastic exit strategy. I sell calls not only to generate income, but to get out of stocks at a much higher predetermined price by using call options. Selling call options brings in premium, and I get to control the price that I want to sell the stock at. And before I jump in and flood your pockets with money, make sure that you smash that like button for Uncle Henry and subscribe, because this is the dopest YouTube channel teaching you how to make consistent income. When you sell a call option, you are essentially agreeing to sell your stock to the option buyer at a predetermined price, the strike price, within a specific time frame, the expiration date. In return for this agreement, you receive a premium from the option buyer, which is essentially the price that they pay you for the option. They are paying a premium for the right to buy the stock, and you are selling them the right to buy the stock, and you are getting paid for it. By selling call options, you are putting your stock to work by generating income from the stock that you already have. If the option buyer decides to exercise their option and buy your stock at the strike price, you still make a profit because you received the premium when you sold the option. So as you can see right here, this is a stock chart. Let's say that we're currently at $100 per share. You buy 100 shares of a stock at $100, okay? If this stock goes to $110 and it goes right here, okay, you're going to make $10 per share, 100 shares, so you're gonna end up making $1,000, okay? That is a stockholder, but how does covered calls work, okay? Is it safer, is it better, or is it riskier than the stock investor? So check it out. Say that you have a stock at $100. Now, as a covered call option trader, you basically say, I don't think it's gonna go above $110. I think for whatever reason, this stock currently at $100, it can rise, it can go up by 10% in say 1 month to expiration, okay? But from here, I don't think that it's gonna go too much more, especially the next month, at most 10%. What you would do is you would sell a covered call, okay? And you would do so at 110, okay? So you would sell it at 110. Now, if you sell it, someone else buys it. It's a very easy process. Someone else is basically going to gamble. That's what I call them. I call option buyers gamblers. I teach people how to sell for consistent weekly income, and I have a Discord in the description link. But for another person that's buying this option, he's basically saying, I hope it goes above 110. I really hope so. I cross my fingers, and I'm betting that the option will go past 110, okay? That the stock will go past 110, okay? So he's gonna be buying that call option. Say it's for $5. You're going to be selling it for $5. So he's gonna buy it for $5, but you're the one collecting $5. Well, when you collect $5, because each option is worth 100 shares, you're actually going to be collecting $500 for the 110 strike, okay? So this is going to be strike, okay? So the 110 strike is right here. So check it out. You're collecting $500 or 5 per share. So instead of being right here, in fact, since you collect $500, you're going to be right here, okay? You're going to be at $1,500. And that's because if it goes to 110, you have made also $10, but you have also made 5 more. So you actually made $15 or $1,500 in profit. Should this stock go to $110 per share, you're going to be better off. Now, what if the stock stands completely still and the stock does absolutely nothing? The stock investor is going to be kind of sad. He's going to say, well, this month I made nothing, which is not too bad in a bear market. But here's what happens as a covered call seller. This guy, right, the investor in just the stock makes nothing. The person buying a call option is actually down $500. He completely loses this premium that he pays. And guess who makes this premium? You do. That's right, you do. Sounds good, doesn't it? Okay, so you're actually going to be right here at a $500 profit. So let's just connect the dots right here. So far, this is not even, but so far, you are above the stock investor and you're also above the call buyer. Not that that's important. What's important though is to see, is a covered call better than just owning stock? So I'm going to stop referring to the call option buyer and start only referring to the covered call seller versus the person that does not do a covered call, that just has stock. Nothing wrong with that, but you do make less money in most scenarios. So for example, now let's say that the stock actually goes down. It goes down to 99, okay? If it goes down to 99, the stock investor has lost $100. He has lost $1 times 100, $100. However, you, since you've collected $500, even if the stock ends during this 1 month expiration at $99, you are still going to be up $400 in profit because you have still collected this $500 worth of premium. So even if it ends at 900, you're still going to be in the profit. In fact, you're going to be in the profit all the way here at 95, okay? At 95, that's your break even because you've collected $5 per share. The price was 100. You've collected 5, so your average break even is going to be 95. So when you make $0, the stock investor is actually down negative $500. And that's why covered calls are such a powerful instrument, because not only do you collect this income, but you are better off than the stock investor in all scenarios. However, I will say there is some opportunity cost. Let me get into that in just a second. I want to discuss why covered calls are considered a non-losing strategy, because they provide a way to generate income from a stock position without taking on excessive risk. In fact, there is no risk other than losing the stock at a higher price if you own the stock anyways. When an investor sells a covered call, they are essentially agreeing to sell their shares of stock at a predetermined price known as the strike price, and if the stock price rises above that level before the option expires. If the stock price does not rise above the strike price before the option expires, the investor gets to keep the premium, which is a good thing for the seller, and they can also sell another call option for additional income. If the stock price does rise above the strike price and the investor is called upon to sell their shares, they still make a profit, as you can see here, and as I'm going to show you where that exactly stops. Covered calls is much different than buying calls, and selling call options is very different than buying call options. To buy a call option, all you need is some capital. As the stock price goes up, so does the option's value. Selling calls, on the other hand, requires you to be covered, meaning you have to have 100 shares behind you to short a call option. I know this is a very big issue for many beginning investors, and that's why in my Discord, I find stocks that are priced well, that are not too expensive, because when you buy 100 shares, you want to make sure that you're not dumping too much money into one position. And it's also not easy to put large sums of money to run this strategy. Although selling call options limits your potential gains above a certain strike price, you receive the premium up front, which is beneficial due to the time value of money. Your profit potential with a covered call is cut off at a certain point, but you don't necessarily need to lose money beyond that point. You just can't earn any more money. In the event of an exercise, a covered call trade represents a gain. So check it out. When the stock goes above $110, this covered call limits you from making any more money. Everything above $110 is going to be the option buyers, because he has bought the rights to buy the stock when it is above $110. So everything above $110 into infinity is actually the call option buyers. However, although it sounds nice that the stock is going to go into infinity, in most cases it's not. And if you actually calculate an area where you think the stock will not go beyond that price point, you're going to consistently collect income, and even if it sometimes goes above, you're not necessarily losing at this point, you just can't make any more money. So what's important to consider to make the maximum amount of money on a covered call? Well, the first thing is stock selection. It is a critical aspect of using covered calls as a trading strategy. When selling call options, it's essential to choose stocks that you have confidence in and believe will perform well. After all, you're going to be holding onto that stock for a while and potentially selling calls on them repeatedly. Selecting the right stocks for covered calls can mean the difference between success and failure. If you choose a stock that consistently performs poorly, your potential profits from selling call options will be limited. On the other hand, choosing a stock with a strong track record of growth and stability can lead to greater returns. Investors should also consider the industry in which the stock operates and overall market conditions. Certain industries may be more volatile than others, which could impact the performance of the stock and the effectiveness of the covered call strategy. However, it's important to remember the higher implied volatility also means there is more uncertainty and risk in the market. This volatility is a double-edged sword. For covered calls, overall, I do like volatility. Covered calls benefit from higher implied volatility because they allow you to sell options at a higher premium, increasing your potential profit. Implied volatility is a measure of how much the market expects a stock's price to fluctuate, and it affects the price of options. When implied volatility is high, options become more expensive, which means you can sell calls at a higher price and collect more premium. This can provide a cushion against potential losses if the stock price drops, and it also means you can potentially earn more from selling covered calls when implied volatility is high. And that's why I'm always notifying Discord of market trends and indicators like the VIX. The VIX is an index that measures the market's expectation of volatility over the next 30 days. It's often referred to as a fear index because it tends to increase during times of market stress and uncertainty. As an investor, you can use the VIX to gauge the level of fear and uncertainty in the market and adjust your investment strategy accordingly. If you're looking to sell covered calls, you may want to consider doing so when the VIX is relatively high. This is because higher volatility generally leads to higher option premium, which means you can earn more income from selling covered calls. On the other hand, if the VIX is relatively low, the premiums for covered calls may be lower as well. The premiums for covered calls when the implied volatility is low is less attractive, and selling covered calls therefore is also less attractive at that time. By keeping an eye on the VIX, you can gain valuable insights into market sentiment and adjust your investment strategy accordingly. Selling calls when the VIX is low is still a viable strategy because we cannot control or time the market. The VIX is a measure of the expected volatility of the market, but it cannot predict the exact timing or magnitude of market movements. One example of the VIX incorrectly working was during the market crash of March 2020. The VIX did not accurately predict the severity of the crash. In fact, the VIX reached a record high of 82.69 on March 16, 2020, but the market continued to decline sharply for several weeks after that. This shows that even though the VIX can be a useful tool in predicting market movements, it is not always reliable and should be used in conjunction with other indicators and analysis that I frequently teach on this channel. Hence why you should be subscribed. Covered calls are especially good during market downturns. For example, let's say that you own 100 shares of Apple stock, which is currently trading at $150 per share. You sell a call option with a strike price of $160, receiving a premium of $8 per share. Then say over the following weeks, Apple tanks down to $142. A stockholder would feel pretty disappointed and concerned about their investment. They may experience a significant loss in their portfolio value of $8 per share. The covered call investor who sold the call option with a strike price of $160 and received a premium of $8 per share would feel better in comparison to the person that just bought Apple stock. In fact, that person would make $8. The stock went down $8, so it would be a complete wash. Even though the stock has declined to $142 per share, the covered call investor would have already collected the premium of $8 per share, which lowers their cost basis to $142 per share. Essentially, the covered call creates a big cushion against any downside risk. When selling covered call options, it's important to understand the concept of in the money and out of the money. An in the money call option is one where the strike price of the option is lower than the current market price of the underlying stock. On the other hand, an out of the money call option is one where the strike price of the option is higher than the current market price of the underlying stock. When a covered call option goes into the money, it means that the stock price has risen above the strike price of the option. This can result in the option buyer exercising the option, which would require the seller to sell their stock at the strike price. Many of my clients don't want to lose their shares because they either like the stock at its new price or they want to avoid paying a capital gains tax. However, as a seller of a covered call, you have the option to roll the call option higher to a higher strike price and a later expiration date. Instead of letting it expire and selling your stock, rolling the call option higher involves buying back the current call option and then selling a new call option at a higher strike price. By doing this, you are able to keep your stock and collect additional premium income from selling the new call option. This can also potentially result in higher gains if the stock price continues to rise. It's important to note that rolling a call option higher is not always the best strategy, and it depends on the specific market conditions. There may be instances where the stock is rising so rapidly that it may be a better bet to just let the stock expire and lose the shares. This is because rolling the option to a higher strike price may not provide enough additional premium to justify the potential risk of the stock rising so much. It may not be smart risk management to own too much of one stock that has appreciated 50%. For me, I roll the options higher because I follow strong diversification and rolling rules. You have to watch my video on rolling right here.